I am told that we have to do it this week. Welcome back to another episode of Deep Thoughts on Securitized Markets. I'm Jay Backow. That's Jim Egan.
Jay,
Jim,
I could go directly into securitized products. We could
can.
start with what happened this weekend. How
You
are you
have to.
feeling?
if you told me at the beginning of the season that the Patriots would be in the Super Bowl, I would not have believed you. Around 6:30 as the game was starting and after the first play or two, when it looked like Sam Darnold was trying to throw a pick six, I was feeling pretty good. When it turned out that we couldn't get a first down for about half the game, I started to feel less good. And to quote somebody that should be on the Hall of Fame, or to butcher a quote, we're on to basketball season.
You have to make a lot of Super Bowls for no team to have won more Super Bowls than the Patriots and no team to have lost more Super Bowls than the Patriots.
Better to have loved than lost than never have loved before. Anyway, Jim, we've spent a lot of time talking about football and sports, which is what I prefer to talk about, but I am told that we are supposed to talk about securitized markets. So valuations have moved a lot in agency mortgages. We think that they're kind of fair here. What about securitized credit?
So look, when we think about securitized products, there is a lot of diversity, a number of different products moving in different directions for different reasons. But overall, we have seen a pretty significant tightening in most securitized credit products. When we look at our bull, base, bear spread scenarios from the outlook, a number of spreads are approaching our bull case at this point.
Look, Jim, we're two guys sitting at a table on TV talking about sports. Let's go around the horn. I'll be Max Kellerman. You can be whichever journalist you want to be. You recently moved to the non-QM bull case a couple of weeks ago. How are you thinking about non-QM?
Yeah, so that is one asset class where, as of last week, we hit the bull case. We moved our call. We were barely in front of the tightening that has already been happening and had already been happening in that space. And that's an area where, look, difficult to see a terrible amount of spread tightening from these levels. Again, we're already at our bull case, but we do think fundamentally, technically, from a relative value perspective, non-QM, especially the AAA part of the capital structure, offers pretty attractive carry here. We've been talking about the $200 billion in agencies. When you think about relative value, non-QM has been screening rich to agencies for a couple of years, but cheap to corporates. Now, when we look at those bases, we do think that we're near the wides of the past 2 to 3 years. So still attractive from a relative value perspective. All of this tightening has happened despite the fact that we've had, depending on how you count non-QM, almost $9 billion of origination volumes in January. That was a record high for 1 month. So we're tightening into record levels of gross issuance. And from a fundamental perspective, we don't think you're going to see that much deterioration from a delinquency perspective. And this is a product where we do think that prepayments are going to be a little elevated given the skew towards more recently originated higher mortgage rate paper. And that means that investors are going to be getting reinvestable principal back to turn around and make this gross issuance story maybe not as much of a headwind as from a net issuance supply technical perspective. So we're at our bull case. We continue to like the top of the non-QM capital structure.
All right, now thinking about another sector as we go around the horn where there have been a lot of headlines and talk about supply, CLOs. Keep on hearing about lev loans. What's our thought there?
When we think about dispersion, fair to say CLOs might be the poster child right now. Software loans in the lev loan market, you have the sell-off there, kind of this AI disruption theme hitting equities, hitting parts of the fixed income market. BSL lev loans, those are going to be in BSL CLOs. Software is the area that, look, we have less exposure than in the corporate credit sector. And if you stay tuned to a future episode of Deep Thoughts, we're going to go into this in a lot more detail. But this weighs in on kind of our thoughts about debt versus equity, about dispersion from a manager perspective, just thinking about how the lev loan market has evolved over the course of this year. You had a very healthy repricing wave of premium dollar priced loans in January. So you had the spread on those getting tightened, but then you have this sell-off of these software names and a number of these loans that continue to trade below 80 cents on the dollar. The combination of that is really tightening excess spread. That's decreasing cash flows to equity. And so from that perspective, we think the environment is something that is still, mezz debt is preferable to equity, but this is an environment where we'd really prefer to be further up capital structures. We think that the high quality carry from CLO AAAs combined with what we still think will be demand from a deregulatory perspective going forward. And we've pushed Fed cuts back into the year. That's going to be continued elevated coupon for CLO AAAs when we talk about a purely floating rate product here. So up capital structures, but a lot of dispersion to keep in mind when it comes to CLOs.
All right. Now, another sector with a lot of headlines and probably is going to continue this year. ABS. We got digital infrastructure. We got the consumer. How are we thinking about that space?
A lot of different topics to talk about in ABS. On the commercial side, the digital infrastructure side, we preferred fiber to data centers coming into the year. And we've seen that. Fiber has tightened. Data centers have widened. We don't think there's a lot more room for fiber to tighten from here, but we do think you're going to continue to see a basis. As we've said in prior research and on prior episodes, we prefer co-location to hyperscalers from a data center perspective. We do think that from a spread tightening perspective at this point, maybe a little bit more on the consumer side. So much has been made about the affordability narrative, which, by the way, continues to support fundamentals in the non-QM part we spoke about earlier. But we do think that's going to be helpful when it comes to consumers' ability to service their debts. From a seasonal perspective, we just saw the record high in certain products delinquencies like subprime auto in January. We were expecting that. Healthy tax refunds, our economists are calling for about a 20% increase. We think that the real refund dollars will be $3,400 to $3,500 on average. That is really going to bring down delinquencies, we think, more so than seasonality would typically imply over the course of the next few months. When you combine that with deregulatory demand that we do continue to think is coming from banks later this year, they buy short duration consumer. We do think that the top of consumer capital structures, especially on the auto side, remain attractive here.
All right. Now, if you stay tuned for next week, I've heard that we have our CRE conference. What are we thinking on CMBS?
So the CMBS space underperformed 2022, 2023. Put it in a pretty attractive position to outperform most risk assets over the past couple of years. If we look at spreads over a 2-year period, AAAs are near their tights. BBB minuses are near their tights. The basis between BBB minuses and AAAs are near their tights. CMBS is rich to corporates, which kind of begs the question, what should the look back period be? If we look back over the course of the past 10 to 15 years, it tells a little bit of a different story. Top of the capital structure, still pretty much anchored near tights. But now you look at the conduit, you look at the mezzanine part of the conduit capital structure, we're in the 50th percentile, both from an absolute spreads perspective, from a basis to AAAs. The top and the bottom of the capital structure screen cheap to corporates over that window. Mezzanine screens about a standard deviation cheap to AAAs over that window. We just published the state of the CRE cycle in conjunction with our REIT analysts on the equity side. We do think that you're going to see commercial real estate prices climb 2% in aggregate in 2026. We think transaction volumes are going to pick up. You are seeing this kind of turn in sentiment from commercial real estate investors. If we're going to go down capital structures, yes, you've seen a very healthy rally in BBB minuses so far this year, but this continues to be the place where we are most comfortable.
All right. So across non-QM, CLOs, ABS, CMBS, we've got a dispersion of views. We got a dispersion of asset classes. We got a dispersion of people to talk to, but it sounds like there's a lot of different opportunities.
Several opportunities in securitized credit across product types. Please don't hesitate to reach out to anyone on our research team if you'd like to discuss any of this in more detail. And thank you all for watching another episode of Deep Thoughts on Securitized Markets.